Hey guys, welcome back to my channel. We have all heard about this famous phrase, cash is king. However, does that philosophy apply to purchasing a home? Being ready to pay cash can give you an edge with motivated sellers eager to close the deal. But it can also help you with sellers in real estate markets where inventory is tight and bidders may be competing for the property. Paying all cash for a house can make sense for some people and in some real estate markets, but be sure that you consider the downsides as well. Let's go through some of the pros and cons. Pros number 1, you are a more attractive buyer. Now, a seller who knows that you don't plan to apply for a mortgage is likely to take you more seriously. The mortgage process can be time-consuming, and there's always the possibility that an applicant will be turned down, the deal will fall through, and the seller will have to start all over again. Pros number 2, you could get a better deal. Just as cash makes you a more appealing buyer, it also puts you in a better position to bargain. Even sellers who have never heard the phrase of time value of money will understand intuitively that the sooner they get their money, the sooner they can invest or make other use of it. Pros number 3, you don't have to endure the hassle of securing a mortgage. In general, banks have tightened their standards for deciding who's worthy of a loan over time. While they might have loosened up somewhat in more recent years, they are still likely to request substantial documentation even from buyers with solid incomes and impeccable credit records. While that might be a prudent step on the part of the lending industry, it can mean more time and aggravation for mortgage applicants. Pros number 4, you'll never lose a night's sleep over mortgage payments. Mortgages represent the largest single bill that most people have to pay each month, as well as the biggest burden if their income falls off due to a job loss or some other misfortune. Years ago, homeowners would sometimes celebrate their final payments with mortgage burning parties. Today, the average homeowner is unlikely to stay in the same place long enough to pay off a 30-year mortgage or even a 15-year one. In addition, homeowners often refinance their mortgages when interest rates fall, which can extend their loan obligation further into the future. Now, pros number 5, you look forward to a mortgage-free retirement. If a peace of mind is important to you, then paying off your mortgage early or paying cash for your house in the first place can be a smart move. That's especially true as you approach retirement. Although considerably more people of retirement age now carry housing debt than they did 20 years ago, many financial planners and retirees see at least a psychological benefit in retiring free of debt. Now let's dive into the cons. Cons number 1, you'll be tying up a lot of money in one asset class. If the cash required to buy a house outright represents most of your savings, then you will be bucking one of the hallowed rules of personal finance, which is diversification. What's more, in terms of return on investment, residential real estate has historically lagged behind stocks according to many studies. That's why most financial planners will tell you to think of your home as a place to live rather than as an investment. Cons number 2, you will lose the financial leverage that a mortgage provides. Now, when you buy an asset with borrowed money, your potential return is higher, assuming the asset increases in value. For example, suppose you have bought a $300,000 house that has since risen in value by $100,000 and is now worth $400,000. If you have paid cash for the house, then your return will be 33%, which means a $100,000 gain on your $300,000. However, If you have put down maybe 20% and borrowed the remaining 80%, then your return will be 166%, which means 100,000 gain on your 60,000 down payment. Now, of course, this oversimplified example ignores mortgage interest, tax deductions, and other factors, but that's the general principle. It's worth noting that leverage works in the other direction too. If your house declines in value, then you can lose more on a percentage basis. If you have a mortgage, than if you had paid cash. That may not matter if you intend to stay in the house, but if you need to move, then you could find yourself owing your lender more money than you can collect from the sale. Cons number 3, you will sacrifice liquidity. Liquidity refers to how quickly you can take your cash out of an investment if you ever need to. Most types of bank accounts are totally liquid, meaning that you can obtain cash almost instantly. Mutual funds and brokerage accounts can take a little longer, but not much. A house, however, can easily require months to sell. You can, of course, borrow against the equity in your house through a home equity loan or a reverse mortgage. However, all of these options have their drawbacks as well, including fees and borrowing limits, so they shouldn't be entered into casually. Make sure you do your research so that you are able to make wise decisions. Let me know your thoughts on this in the comment section below. Don't forget to subscribe, hit that notification bell, give the video a like and share it with your friends and family.